Okay, welcome back. Here we are in the 7-day crypto profits accelerator. Today, mindset, the investor's mindset. But before we jump into that, quick recap where we've come, where we're going. Day one, of course, how yield farming works. Day two, funding your first wallet. Then we talked about the strategic approach to kind of tying this all together. Day four, quite possibly the most important piece, avoiding scams and staying safe so you don't lose money from the get-go. Day five, actually the nuts and bolts, click by click, how to open your first liquidity position. And then on day seven, we're going to revisit that position. We're going to take a look at what the actual APR has been as sort of like a slice in time, right? We're going to say like, hey, here's what it is so far. Here's the projected. Here's likely what the outcome of that position will be. Now, before we do that though, today, day six, the crypto investor's mindset. Now, with this one, it's tricky because we could talk about any number of different mindset variables that can and do have a direct influence on the decisions that you make in this world of decentralized finance. And of course, the decisions that you make influence the profit that you actually collect at the end of the day, week, month, and year. So what I tried to do was narrow it down to just a few principles. So remember, we talk about principles, strategy, tactics, and tools. Up at the top is principles. Now, normally you would start there, but I wanted to kind of show you like some nitty, because I know everybody thinks they need the tactics and the tools, which you do, but they can't exist in isolation. They have to be part of a bigger overall strategy, and that strategy has to be informed and influenced by the principles that shape how you think, which then determines the actions that you take. So I'm going to share my screen and kind of walk you through what I believe to be some core foundational principles that will influence everything else that you do in the world of decentralized finance. And I know everyone wants to skip this part, but as we'll get to one of the principles, which is slowing down and exercising restraint, it is vital that you, for this session, just kind of like take a deep breath, slow down, and go, okay, I might not be learning the button clicking today. That's okay. I learned that on different days, but you are exposing yourself to what I believe are some general thought patterns that will determine ultimately if you're successful in this or not. Because, and this is my opinion, but I believe that this opinion is shared by a lot of really wealthy investors, is that if you're going to lose in any market, crypto or otherwise, it's usually more a manifestation of your own psychological and emotional volatility than it is anything else. And no one wants to admit that. But, and I'm me included, as soon as I admit that to myself, I go, oh, now I can look at my own emotional volatility and just go, oh, but humans were predictably irrational. Like, we don't always make the best rational choices. But once you acknowledge that as like a condition of your existence and reality, you're able to look at it objectively and then, as often as possible, make a decision that doesn't lead you down that path of emotional volatility. So let me put this up on the screen here and we'll dig right in. Number one, and this is extremely important. Obviously, this is why I put it as the first one for our mindset: closer versus more. And this is especially true in the crypto markets, where people want 50x, they want 100x, there's lots of hype. And can you earn 50x in crypto? Sure, but people want 50x now. They want more and more and more. They want 50x in a month. They want 100x in a year, this kind of stuff, okay? And what happened, and I've done this before. I've chased more and more and more. In fact, when I first got started in crypto, I was kind of trying to do more like the day trader meme coin kind of approach, which is a lot of like, get in early, get in fast, watch the charts 8 hours a day, and then like sell off really quick. So you can like, bam, hit the big money. Problem is you lose more often than you win, and you can make money. It's just like super stressful and chaotic. And I didn't really want to live my life that way. And I was definitely living from a place of more and more and more and more, which didn't serve me, because at one point on one particular position, I was up. I was up over 40,000. And this was just like one little trade I put in, I think it was like maybe 1,000 or something like that. It wasn't very much. And I was up to 40,000 and I could have just cashed it all out. But I was thinking in terms of, I want more. It's going to keep going up. It's going to keep going up forever, which nothing ever does. And of course, with these kind of meme coins or shit coins, they often tank and they don't recover. Okay. So they go up in a day, they tank in a day, and then it's all over. Like they're not going to recover. Whereas legitimate projects, they might go up and down and up and down and up and retrace up and retrace up and long term they go up and to the right, but they follow more like general patterns of normal charts and how those flow. But this particular case, I was like, no, more, I want more. And then it ended up tanking and I lost a whole bunch of money, or rather, I lost unrealized gains. I ended up getting my money back and I made like a couple $1,000s. So it wasn't a loss. It was just that because I was operating with greed, I missed out on a lot of gains that I could have had, but instead I was like, no, I want more. And if you think about it, if you put in 1,000 and you have a chance to cash out 40,000, why wouldn't you take that? Even if it maybe possibly could have gone up to 60,000, you go, yeah, but I just locked in a 40. Yeah, like I locked in all these gains. Now, I'm not advocating for that type of trading anymore. Obviously, we're talking about a different approach altogether, but that's where this mindset comes in to say, hey, every day, every month, every year, if I get closer to my big picture goal, I win instead of trying to get more, which again, the principle informs what our strategy and tactics are. This is why I tell people flat out, hey, listen, 100 or 50% to 100% on the APR side from trading fee income. This is what we've been talking about with yield farming, from trading fee income. Even if that was all you got, which is still insanely good, let's say you just got 50% year over year. It might take you a few years to get to where you want to go, but every year you would gradually be getting closer and closer and closer in an accelerated way to what you want. And so again, if you can find 74% APR, if you can find 58% APR, whatever that number is, if you can find that and you can earn that by holding and pairing like really reliable blue chip assets. Remember, we're not chasing more, we're not chasing 100x, we're not chasing meme coins or anything of that sort. If you can lock in those kinds of gains, you're getting closer to what you want. So you might say, well, Brandon, I want to start off with $20,000 in investment capital. Maybe I have more, but that's what I'm willing to put into crypto. I go, great. Well, what's the big picture goal? And you go, you know what? If I could land at 5 million, then I would have everything I ever wanted in life. I'm just making these numbers up, right? Your number might be like a lot lower, a lot bigger. I don't know. But let's just say your big picture goal is 5 million. I could retire. I could live off the interest. Like I'm set. Like that's all I really need. I go, great. So how would we get there? Like what percentage return would it take? And I haven't even done the math on this. But it's fun to say like, hey, just sort of as a rudimentary, let's say I get 80%. Okay. So I'm at 1.8 and I'm going to take that to the 8th power. Nope. Let's take that to the 9th power. Let's take it to the 10th power. There we go. So somewhere between year 9 and year 10, year 10 would get me up to 7.14 million. And that's with just an 80% return year over year. Okay. Is that a guarantee you're going to get that every year? No, there's never any guarantees. The whole crypto market could implode tomorrow. I don't think it's going to, but it could. Okay. The point of this is just to say, hey, with some example math, you go, you know what? I'm patient enough to wait 9 years or 10 years if it means I get everything that I ever wanted. We don't like to hear that. We go, hey, Brandon, how quickly can I get to that 7.14 million? Well, you can shoot for it in 3 years, but here's all the additional risk and craziness you would have to endure in able to get that. And it's not even remotely guaranteed that you would make it there in that time frame. Okay. Now, personally, I believe that with crypto, there are accelerated time frames, but I'm saying even if all you got was that 80% year over year, you would still be doing very, very well. And keep in mind too, This 50 to 100% APR, we're talking about just the trading fee income. That does not include any long-term appreciation of the base assets that you are leveraging in order to create that cash flow and that trading fee income. So I don't want to belabor this point too much, but the idea here is think ahead of time, where do I want to be? Think ahead of time, how can I gradually and incrementally take steps to get there progressively over time, rather than always trying to get as much as I can in as little time frame as possible. Because shooting for as much as I can, there's not a concrete goal there, right? So you're going to end up like me, where you go, hey, I put in 1,000, I got 40 back. Great. I want as much as I can get. So I keep going for more and I end up losing a majority of the gains that I could have realized. So you want to realize gains as often as possible. And that's part of this strategy, because accumulating trading fee income, I'm getting closer every day, because every day I'm accumulating more and more assets that I believe in long term that can appreciate in value and compound the gains that I otherwise would not have had if I had held those assets unpaired and just buy and hold forever, right? Buy and hold forever is great, but we can add to that in a responsible way. And it applies this principle of every day I'm accumulating a little bit more. Okay. So that's number one, closer versus more. Number two, slowing down, slowing down and restraint. And we just touched on this, but the idea here is everybody wants to get it super speedy fast, right? That's kind of like the main thing. How quickly can I get to where I want to be? And what happens naturally is when we try to go too fast, we'll end up making impulsive choices. Okay. And again, nobody likes to admit that they are susceptible to this, but you are, I am, we all are, in that if you don't have like a structured path for decision making that exercises restraint by default, you'll end up seeing something online and you get FOMO and you go, oh my God, this one influencer on Twitter said, I better buy this coin now or I'm going to miss out on it. And that ties back into closer versus more, right? Hey, if you're already on track and you're getting what you want, why do you want to chase more and more and more and more at the risk of, well, at the expense of adding more risk? So slowing down and restraint means whenever I feel that like there's a good sense of urgency, right? To like, hey, I want to do something, I want to be productive in the world. But then there's that like nasty sense of urgency, which is like, I better make a decision right now or everything's going to explode. And we can easily fall into that, especially in crypto, and especially because most of the media that publishes stuff about crypto, whether it's legitimate media sources or just random people online, most of it fits into this paradigm of like, do it now or else something's going to fall apart. So that leads us to making impulsive choices, and the impulsive choices breaks down our strategy. Remember, we talked about that at the other session, what the strategy is and how it works. If you stick to the strategy, you will get closer to what you want. If you make impulsive decisions and you follow the hype and you go too fast and you chase more and more and more and more, the strategy falls apart completely. And now you're no better off than any random person making random decisions online. Okay. Slowing down, exercising restraint. Number three, investor versus trader. Now, will you make swaps, trades? Will you make swaps in DeFi if you participate in this? Absolutely, you will. What I'm talking about is the trader mentality is very short term. It's very much like, let me buy this low, sell it high, make a quick profit. Yeah, I made money. That's good. There's nothing wrong with that. I'm just suggesting a different path based on my personal experience and experience of all our investors and members inside the mastermind. Whereas an investor is, of course, much more long term. Now, here's how this plays out on a practical level. Someone buys an asset, two assets really, and pairs them together. And they go, hey, I really believe in B&B and I really believe in Fetch AI. So I'm going to buy some B&B and FET and I'm going to pair them together. Now, let's say I'm new to this and I'm not really sure about market timing and whatnot. And I go, you know what? I'm just going to jump in because I want to be in the market, right? Time in the market, not timing the market. I want to be in the market, so I'm going to buy these assets. And in the first month that you're holding these assets, they go down 30%, which in crypto, that happens. Things go up like crazy and they retrace like crazy. They go up like crazy and they retrace like crazy. Now, if I was the trader mentality, I probably would have cut my losses sooner. Actually, I might have said, "Oh man, it's down 20%. Let me cut my stop loss, and move on to something else." But if I'm an investor and I've chosen assets that I truly believe in, right? That's why asset selection is such a critical part of the process. I've chosen assets that I truly believe in. Well, if they dip a little bit, I'm okay. I go, you know what? It's all right. I know they're going to recover. I know long term on the 12 to 18-month time frame, they're more than likely to go up in value over the course of that long term. Plus, even though they dipped, well, lo and behold, while they were dipping, I was still collecting trading fee income. So even though, let's say I put in 10,000 in base capital and it dropped 30% down to 7,000, well, I'm still okay in this scenario. I'm still okay because I'm still earning my trading fee income. And then when those assets recover and then do appreciate in value, and again, I'm just making up some random examples here. Let's say they appreciate back to the original plus 30%. Now they're up to 13,000. And I've got all this extra trading fee income that I was accumulating while the market did its thing. So market goes up, market goes down, market goes sideways. You're still collecting trading fee income because that is based on trade volume, not directly related to the price on the chart. Now, if the price on the chart on both assets that you're pairing goes down to zero and the whole thing collapses on itself, yes, that does matter. Okay, then the APR and the trading fee income is meaningless. But that's why we're adopting the investor mentality rather than the trader mentality. The trader might say, I'm going to buy some Pepe, I'm going to buy some Sheep, and I'm just going to wait, and then I'm going to sell it off when it moons. There are people making money like that. It's just that it's a short-term game. And even though you might double your money one time in the short term, and you go, Brandon, I'm a really great crypto investor. I put in 10,000 and now it's 30,000. I go, great. If 30,000 was your long-term goal, you won. But if your goal was to start with 10,000 and accumulate 5 million, yeah, I mean, you kind of won. Like you're getting closer, right? You're getting closer, but you don't really have like an actual strategy that's going to get you closer after you made those trades. So a lot of people, they joined the trading game, they got short term and they've hit some gains, but a little bit of luck, maybe a little bit of skill. Maybe you heard one person on Twitter or YouTube make a call and you followed along and you won once. But the problem is if you keep doing that, probably at some point, in all likelihood, you're going to lose more than you win, and you're actually going to be further and further away from your goal rather than closer. So what I'm suggesting is by adopting a long-term value investor mindset, even in the world of cryptocurrency, which is it's an alternative asset class, it's an emerging asset class, but you can still apply the same value investing principles to this new and emerging market. And yeah, it might take you a little bit longer than the person who, made $50 million trading Bitcoin 10 years ago. But you are in a position where you're calm, you're cool, you can slow down, you can exercise restraint and patience, you can become a long-term value investor in this space of decentralized finance, and you still long-term get closer and closer and closer and closer to ultimately what you want. So investor rather than short-term trader. Okay, productive assets. Now, we've touched on this before, but I wanted to make sure to really drive the point home here because even if you're a value investor and you have a long-term mindset, you can invest in non-productive assets. Okay, so if we wanted to do like, hey, what's the longest long-term hedge against inflation? I go like, well, buy some gold, pass it on to your children, and 100 years later, it'll be worth a ton more. But in all likelihood, it'll have the same buying power if you convert it back to cash. It'll have the same buying power at that time that it did today, because you're probably only going to beat inflation. Maybe you make a little bit. But the point is, you bought the gold. All it is a lump of gold, and you can sell it later and That's all it is. It's not a bad investment, depending on when you get it, but it's a non-productive asset. When we talk about productive assets, the easiest uh, example that most people are probably more familiar with would be real estate. Okay, I buy the real estate, and when I buy it, it's worth 1 million. And again, I'm not going to pay attention to the short-term fluctuations, like our example above. If I buy a coin, it goes down to 7,000, and then back up and back down and back up. And this real estate, after I buy it, it might go down to 850 at one point. It might come up to 1.4 million. It might go back down to 1.1 million. But ultimately, when I sell it 20 years later, it has appreciated in value to $2 million. Great. I made a profit on the base asset that I bought, right? It appreciated in value from 1 million to 2 million, and there's profit potential there. But because I invested in a productive asset, I can also rent this house out. And let's say I just rent it out, I don't know, I'll make a number up, 3,500 a month. Now I have times 20 years, what is that, 240 months? Now I have 240 times 3,500, I make an additional, whip out the calculator here real quick, 240 times 3,500. Hey, pretty sweet. I made an additional, over the course of the long haul, 840,000. So I would have profited 1 million if it was a non-productive asset in this real estate example. But because I made it productive, I actually profited 1.84 million. Can you see the difference there? Huge difference, right? And I didn't even mean for this to fall in our target range, but this is literally an extra 84%. Okay. So this would actually, it would kind of mirror the ideal APR that I outlined for our approach with crypto, meaning let's say your base assets double in value, but if you're adding 80% APR to that, that makes a huge, huge, huge difference overall, especially if you compound it year over year over year over year over year. Okay. So this is just illustrative, right? No guarantees. I'm not saying these will perform exactly like real estate. It's just the premise of having a productive asset, and this would be real estate, but we're saying like, hey, with crypto, the mechanism through which we make our crypto assets productive is yield farming, because you could just hold those crypto assets. And again, it's contrasting. Just buy and hold. It's fine. You'll make money probably at this point. Or let's do something with it. Let's make it productive while we're holding it in the meantime so that we can win in both of these spaces. And again, with a long-term value investor mindset, when we do this, we're not chasing 800% APR. We're looking for assets that are highly correlated, that can produce reasonable APRs that are sustainable over the long haul, that will get me closer to what I want. Big picture goal. Okay. And then the last one, obviously, part of this process for me is not only teaching you these things, because you could just take this and roll with it for all I care. That's great if you're able to do that. But also is to talk about the mastermind community and where that fits in as well. Because chances are, if you're exploring this world, you've probably thought at one time or another, hey, maybe I should get some help. Like maybe there's someone who's done this before, a mentor figure. Maybe there's like a group of people that are doing this together. That'd be pretty sweet to find. And that's what we've built here. The mastermind community is a combination of being in community with other investors, but also having mentorship in one-on-one and group format so that you're able to exercise all of these principles that we just highlighted today. But the idea of community versus hype is that if you are just solo, if you are the Lone Ranger, you are at the mercy of every little hypey thing that you hear everywhere on the internet. And, I don't think you should only ever listen to like one voice, right? Because there's a lot of good people that have great input into your life, especially in the world of investing. But if you try to go it alone, how do you filter what's good information and useful information from what is just scammy hype? Like, how would you filter that if it was just you in a silo, in an echo chamber, and you're like, I don't know how to handle this? Whereas community, you don't have to live that way. You've got other investors, like-minded investors, who are part of a mastermind community. And by the way, this is not 10,000 people in the group. It's at this stage, where are we at? May 13th. At this stage, there's 155 people in there. So I keep it pretty small and tight knit, but that's intentional. That's why there's an application that you have to fill out ahead of time to even qualify to see if you're a good fit for the community. Because yes, I can teach anyone, but I also want to preserve the integrity of the community as well. And when you operate in the context of a community, now it's like, hey, everyone, I read this thing on, whatever kind of coin market cap or whatever media outlet that you're subscribed to. What's going on here? Like, who else has heard things? Who else has studied this? Who else has taken a look? And then other people can share their experience rather than just being an echo chamber of I heard, they heard, she heard. It can be like, well, you may have heard that about XYZ asset. Here's been my experience that I've been invested in it for the last 3, 6, 12 months, what have you. And here's how that perspective might inform the decision that you then want to make. And yeah, ultimately, we're all adults. We're all making our own decisions about the things we invest in and where we put our dollars. But having other people around you, voices of legitimate input and wisdom, can shape ultimately the decision that you end up making. Okay. So again, this is just my opinion here, but I think community is actually the most profitable path. And I say that because early in my crypto journey, when I got started, it was literally a friend of mine who just said, hey, like, check out Chainlink. You should buy some of this. And I was like, okay, I'll buy some. And I just bought some, right? I just listened to my friend and did that. But then I realized, hey, there's more to this. And I took the path of mentorship and community as well. Because I was like, okay, I got my friend, and that's great. We can chat about it. But I want some input from other people who are like actually thinking critically about this. And that's when I started taking courses. Some were really great, some were not so great. And then I started joining masterminds. And again, this is just my story. For me personally, the masterminds were the most valuable experience because it wasn't just, hey, here's some information, right? Like you can go to YouTube and type in what's yield farming, and you'll get like an explainer video. And great, it's nice information, but a community can actually like help you navigate where you put your dollars in order to create the intended profit outcome that you're after. Okay. So, like I said, I don't want to belabor all these points. I don't want to draw it out too long. I just wanted to draw your attention to these principles that I think are important for all of us, myself included, to keep top of mind as we engage with these alternative asset classes and these emerging markets. Okay. So this exercise to intentionally shape how you think will absolutely 100% influence the net result that you get at the end of the day. So keep these things in mind. And as you work through the rest of the content, especially tomorrow's, just know that, yeah, all these are great things to keep in mind. But if you're looking for a community, if you're looking for a mentor, then the best thing to do is to go ahead and click the apply button for our crypto investors mastermind. We put all of these principles into practice on a regular basis. And it's not uncommon for a member to come to me with, hey, I've been thinking about doing such and such. And I'll be like, you know what? You're probably, from what you're telling me, you're probably about to violate this principle. So I don't recommend that. But again, we're all adults. You can make our own decisions. And then I'll get a response back. You know what? Actually, you're right. Like I was about to violate that principle. So it's just nice to have other people close to you that can help you on that journey. Okay. As always, if you have any questions about any of this, whether it's about application or just about the content, post your questions in the Facebook group. Okay. Even because I just published this material not too long ago. I'm going to leave it published for a few months, but I just published it, and there's already people dropping questions and comments and thoughts in the Facebook group about what's going on. So if you have a question, put it there, tag me. Okay. @ Brandon Hofer. tag me. I get an extra notification that someone posted a question, they've tagged me, and then I can respond directly to you. And then potentially either myself or someone from my team might send you a direct message as well. That's really just to give you more information and help you along the journey and answer your questions, okay? It's not, we're not going to drop weird spammy links or anything like that in your DMs. It's just going to be kind of talking about it. And yes, if you do want to apply, there might be an application link. But beyond that, if we send you anything, it's just going to be additional resources and helpful material that will help you continue your path towards learning about the world of decentralized finance. That's all for today, and I will see you for day 7, where we get to harvest those gains and talk about, all right, I went through the process, like, what do I do with these these gains, this trading fee income? How do I maximize the long-term yield, and what do I do to compound the gains that I've gotten from the trading fee income? See you there.